Let's talk about 1997. It was the year a financial tsunami just ripped through Asia, turning what everyone thought were economic miracles into absolute meltdowns, seemingly overnight. It started in Thailand and then spread like a virus, and for a minute there, it felt like it could take down the entire global economy. We're going to dive into this story of incredible success, sudden collapse, and the lessons that are still ringing in our ears today. You have to understand, before the crash, the mood was absolutely electric. Economies like Thailand, Indonesia, Malaysia, and South Korea, they were the envy of the world. People called them the Asian tigers, and their success was hailed as this Asian economic miracle. It was attracting just a massive amount of investment and seemed to promise this limitless growth. And this chart, wow, it really shows you just how fast the party ended. Look at Indonesia in 1996, growing at a staggering 8%. Fantastic, right? Well, just 2 years later, it had shrunk by 13%. This wasn't a gentle slowdown. It was like hitting a brick wall at full speed, a complete, brutal reversal that threw millions of people right back into poverty. So how on earth did a miracle turn into a meltdown? I mean, that's the big question we're going to tackle. How did some of the world's most dynamic, exciting economies fall so hard and so fast? The story really has all the elements of a thriller: hot money, hidden risks, and a single domino that ended up knocking over an entire region. All right, so to really get the crash, we have to rewind a bit and look at the boom. What made these economies so incredibly attractive in the first place? Well, it was this potent combination of factors that, on the surface, looked like the perfect environment for investors. You see, all these elements fed into each other in this really powerful cycle. You had high growth and high interest rates pulling in enormous amounts of foreign money. And this flood of capital felt deceptively safe because the local currencies were pegged to the stable US dollar. All that cash, in turn, fueled this massive bubble in assets like real estate and stocks. And this currency peg, this is absolutely crucial to the story. For foreign lenders, it made it seem like there was almost no risk. You know, if you lent out money in US dollars, you felt confident you'd get paid back in dollars at the same exact value because the exchange rate was fixed. This encouraged just enormous amounts of borrowing, a lot of it for some pretty risky projects. And the scale here is just staggering. In 1996, the year right before the crisis, a net $93 billion of private capital poured into just 5 of these economies. That's an incredible tidal wave of money chasing returns. And it created a system that was highly leveraged and, as it turned out, dangerously fragile. So the stage is set, everything's booming. How did it all fall apart? Well, it all starts in one place: Thailand. The crisis there was nicknamed the Tom Yam Kung crisis, after the country's famous hot and sour soup, which is a pretty fitting name for a situation that was about to get very hot very fast. And the speed of the collapse was just breathtaking. I mean, think about it. In May, speculators started betting that the Thai baht was way overvalued, so they start borrowing it and selling it like crazy. To defend the peg, Thailand's central bank had to use its limited supply of US dollars to buy up all that baht. By July 2nd, the game was up. The reserves were gone, the peg broke, the baht's value just plummeted, and by August, the country needed a massive bailout. It took less than 3 months for that first domino to topple completely. Okay, so what was the fatal flaw here? It boils down to this really simple but deadly mismatch. You had companies borrowing money in US dollars that had to be paid back in just a few months, but they were investing it in things like giant office buildings that wouldn't make any money for years. So when investors got nervous and the currency collapsed, the value of those dollar debts just exploded, bankrupting businesses almost overnight. Now, what happened in Thailand didn't stay in Thailand, not even close. It was the trigger, the first domino in a long line that was about to fall across the entire region. The panic spread like wildfire. And that right there is the textbook definition of financial contagion. Investors looked at what happened in Thailand, the currency peg, the bad loans, the real estate bubble, and they saw the exact same warning signs flashing red in Indonesia, Malaysia, and South Korea. They didn't stick around to find out what would happen. They pulled their money out immediately, which, of course, created the very crisis they were afraid of. And the results? Absolutely devastating. Just look at these numbers. The Indonesian rupiah lost over 80% of its value against the dollar. The Thai bahts and the South Korean won were basically cut in half. I mean, can you even imagine your life savings losing that much value in just a few months? That was the brutal reality for tens of millions of people.
You can just feel the shock and the anger, right? I mean, listen to this quote from Malaysia's prime minister at the time, Mahathir Mohamad. He famously lashed out at international currency traders, even singling out George Soros by name. He was voicing a feeling that was shared across the region, that their economies were being destroyed by rogue speculators.
And this is so important to remember. This wasn't just about numbers on a screen or stock charts. It had huge real-world consequences. In Indonesia, the currency's collapse led to hyperinflation. The riots that followed over the price of food and fuel, well, they ultimately forced President Suharto from power after more than 3 decades of authoritarian rule. So the whole region is basically in freefall. And that's when the international community, led by the International Monetary Fund, or IMF, steps in. But the cure they offered, well, let's just say it was almost as painful as the disease, and it's still controversial to this day. So the IMF comes in and organizes these massive bailout packages. We're talking about $40 billion just to start for the 3 countries that were hit the hardest. The goal was to stop the bleeding and stabilize the currencies. But, and this is a big but, this money came with some very, very strict strings attached.
And what's really fascinating is when you compare the IMF's playbook from '97 to what happened in the 2008 global crisis, it's like night and day. In 1997, the prescription was old-school austerity: raise interest rates, slash government spending, shut down weak banks. A decade later, the approach in the US and Europe was the complete opposite: cut rates to zero, pump in stimulus, and bail everybody out. It really shows you how much economic thinking changed. So what was the thinking behind this tough medicine? Well, this quote from the IMF's director at the time lays out the logic. You hike interest rates to make your currency more attractive and stop the freefall. But critics said this was like throwing gasoline on a fire. It absolutely crushed already struggling businesses with impossible borrowing costs. And many argue it pushed these economies even deeper into recession. Okay, so eventually the storm did pass, but it left these deep, lasting scars on the whole region's economies and, more importantly, its societies. And it taught some really painful but powerful lessons that completely reshaped how Asia thinks about money and its place in the world. Let's talk about the real cost, because it goes so far beyond the financial markets. It's not just about corporate bankruptcies. We're talking about millions of people losing their jobs and being pushed right back into poverty. And the human toll was tragic. In just Hong Kong, Japan, and South Korea, an estimated 10,400 people took their own lives because of the economic despair. It's just devastating. So, what changed after all this? A lot, actually. The mantra across Asia became never again. To avoid ever having to go to the IMF again, many countries built up these enormous war chests of foreign currency. They beefed up banking regulations to crack down on risky lending and weakened the old systems of crony capitalism. And you know who was watching all this very carefully? A rising China, which learned a lesson and became far more cautious about opening up its own financial system. And all of this brings us to the big question, doesn't it? More than 25 years later, with global debt higher than ever and money flying around the world at the speed of light, have we really absorbed the lessons of 1997, or are we just waiting for the next contagion to strike? I'll leave you with this powerful thought from the economist Stephen Grenville, which I think is pretty sobering. The story of the Asian financial crisis isn't just history. It's a stark warning that it's not a matter of if there will be another crisis, but when and where. So what's the big takeaway here? The crisis showed us just how quickly confidence can evaporate, turning boom to bust in the blink of an eye. It hammered home the dangers of borrowing in foreign currencies and the catastrophic social costs when finance goes wrong. For the market, it was a brutal lesson in contagion risk and a catalyst for change, proving that in today's globalized economy, no country is truly an island. This is not financial advice.